I have the best inflation indicator in the world, workforce growth. No economist would think about that. Incorporating young people into the workforce takes investment in computers and trainings and offices, all this sort of stuff. That's the biggest correlator with inflation over time. Inflation has been falling since 1980, right with my indicator. It should be 2% today. And what's it at? 6.8. We'll call that 4.8% inflation created entirely out of the recent stimulus. So that's what the stimulus has done. As soon as we have a slowdown in the economy or they stop stimulating, I agree, inflation's going to fall off. We could be at peak now or soon, would be my guess, more like with Jim Brigham. But it's going to take a drop in the economy to stop. If the economy does not slow down, we do not have this downturn, then inflation is likely to edge up at least for a little while. So, but inflation's already up way more than it should be because of stimulus. So. And the stimulus is no longer escalating. They're looking at tapering it. So I say, yeah, we're probably near peak inflation, and it should go down to zero or negative. And then when we come out of this downturn, you are not going to see inflation over a couple percent for the rest of my lifetime, and most of the people listening to this, almost guaranteed.
Look, you've been calling for this crash for quite a long time. In 2021, you were looking for it to happen in April, then in June. So I have to start with this. You've been wrong on those calls. Why are you certain now?
Okay, it's as simple as this. We're in what I call the orgasmic phase of this bubble that's just been building and building. People have to realize since 2007, and I called that one 20 years before it happened, late 2007, baby boomers peaked in their spending. We had a peak in the stock market in late 2007, and we went into the first deep recession since the early 80s and the early 30s, okay, the Great Depression. And that's when the Federal Reserve and central bank just went nuts. We have printed more money in the last year and a half or so than all of the printing before this, and even since 2008 and 9. I mean, just years and years of this. So they keep doing exponentially more. So they're just desperately keeping this bubble going. And when you get in this phase, there's no way to say, oh, it's going to happen this day or this month. I mean, I was able to predict the 2007 top because I could precisely determine within several months when the baby boomer was going to peak and momentum was going to turn down. But this is just a bubble's going to go until it bursts. I'm now looking literally at chart patterns and things like that to see when this bubble looks like it's going to pop. And this looks like one of the times right here in December where it could top. If not that, it'll be early next year. After that, I'm going to be shocked if we do not see a downturn. So it's at the point where, to me, this is such an extreme bubble. If you're hanging in there to say, well, maybe it goes another 3 or 4 or 5 months, I'm like, get out. What my research does show 100% is that when a bubble like this bursts, you're going to see 40 to 50% crash in the first 2.5 months. And if you sit and wait for that, it'll happen before you're ready. And then you'll panic when that happens, and then it'll bounce, and then you'll look like a double idiot. So this is very tricky. And I think Baron Rothschild, the richest man of the 1800s in Europe, said, what is the secret to my success? I always got out a bit early. Okay, that's what I say. Be on the early side. And this is already way later than this thing should have gone. But the governments are exponentially selling more. Now, for the first time, with the economy only coming back in recent months, it was declining in the second, third quarter. Okay, after all that stimulus, it was declining. Well, it finally came back with this, recent stimulus. Okay, this has put them in a bind. They now have almost 7% inflation, and the next report's probably going to be higher in December. We're going to get that January 12th. And the economy has suddenly gotten strong. It was weak. Now, so they have to tighten. What I'm telling people, Danielle, when you have an economy that's now been stimulated for 12 years against fundamental demographics, against slowing even technology, all my cycles are slowing at this point, and most of them for years, it will not take much to prick this bubble. That's what I'm saying. So just them saying we're going to have to taper and just starting, they're already cutting $30 billion a month in buying bonds, and they're supposed to finish tapering that and then raise interest rates by March. You're going to get a top in here by early next year. I say it looks like it's happening now. That's all. But I cannot. I cannot be accurate at this stage on precisely when. You just
Okay.
can't.
So, and just to go back to the timing, I get it. I've said the same thing to Robert Kiyosaki. It's hard to stick your neck out with a certain call. But why do you think the mark was missed on your original forecast of April and June? What happened?
They just keep pumping it up, and the markets keep buying. I mean, at this stage, the market will only go down when something triggers that's big enough, or the last person gets in the stock market, and it's hard to tell which of those. But I think what typically happens, Danielle, and this has been every top in this boom since the early 80s. When the stocks markets go up for about a decade, they usually get pricked when the interest rates, inflation starts to rise late in the boom, and the bond rate, the bond rates go up. Now, the big thing right now, which is extremely unusual, we have 6.8% inflation and rising, and the 10-year Treasury bond is yielding 1.4%. That's like a negative yield of 6-7%. So that I think the Treasury bond if it keeps edging up, that could be the trigger, but we're just way beyond this thing.
Harry, let me ask you, because that is the concern, right? That when the Fed would start tightening, what impact would that have on the stock market? But the Fed knows this, right? So won't they do everything in their power to avoid a stock market correction? This is what they've been working so hard to avoid. They've been pumping. Why would they just put their guard down? Why would they have?
You got to remember, there's a lag to everything. Monetary policy lags about 18. Now it starts, but it lags about 18 months in its real effect. And so they've been forced to start to taper off. What I keep telling people, you got to understand addictions, you got to understand bubbles. They're both the same thing. Something blows up, it takes exponentially more to keep a bubble or an addiction going. And all it takes is just pulling back. You don't have to stop the stimulus, just less stimulus, and then no stimulus is all it takes at some point. So it's just a matter, and so now they're forced to get a little more tight. Well, if they're going to decide, if they pull back and immediately get easing quickly, it's going to look like they're panicking. So now that they're in a tightening mode slowly, it's going to take them a little while to respond and go the other way. And in that time, again, remember what I said at the beginning, 2 to 3 months. Every major bubble burst has happened within 3 years, and it's been from 42% to 50%. And my calculations on this one that's been so stretched is it's going to be 54% the first crash. If that first crash happens, if they just slip that long, people will lose confidence in this market. Imagine if the S&P dropped, 54% in 2 months. You think anybody believe, oh, well, they'll just print money again, it'll come back. You will not see the market come back if it crashes that much. I will almost guarantee you that.
Are there certain sectors that will be saved, or where do you see the ones getting hit hardest?
Well, yeah. Obviously, it's the small caps the small caps are about, if they break 2,100, that's going to be my first signal. This really is a top, and we're about 50 points from that today. Okay, couple of percent. The small caps lead, and of course the tech stocks follow. Those will be the ones hit the most. If you get, healthcare and defensive nations and consumer staples, of course, those are going to hold up better. But in a stock crash like this, after a major bubble, everything will go down, including utilities. It's just those sectors will go down 40 or 50%, and then the leading sectors will go down 70, 80, 90. So that's the difference. There is no safe place to hide. The only place to hide, which was proven in 2008, and it wasn't gold. Gold went down 40, 50% in the worst of that crash. It was the U.S. 10 and 30-year Treasury bonds and the U.S. dollar that bounced in that crash in late 2008 when it was at its worst. That was the safe haven. That's what I'm telling people to do. Get in Treasury bonds. I'd even wait here to let inflation get a little higher, maybe wait until early January, then get in these Treasury bonds and just sit there, and whether the crash happens now or a couple months from now, when it does, it's going to come like a freight train. That's what history says. Workforce growth is going to be damn near zero as we go into the future for the U.S. and Europe and Japan and the Eastern Asian countries developed are worse. So inflation is gone forever.
Stagflation?
Well, no. The 70s was stagflation because the baby boomers were entering the workforce. You have to remember, we weren't printing money in the 70s. We were running deficits, but governments are going to run deficits when costs are going up and you're having recessions. So from the late 60s to the early 80s, it was an inflationary, recessionary economy. That's called the summer season, okay, in my long-term thing. That's what you expect to happen. This is not that. This is temporary inflation that is not going to last past as soon as the economy slows down, and it's not going to come back when we get out of it. So you won't see inflation at 7% a couple years from now. Will not.